grab a seat. We need to talk about IAS 8. Yes, the standard that dictates how we handle accounting policies, changes in accounting estimates, and errors. Sounds dry, right? But in my world, IAS 8 is the only thing stopping a CEO from turning $1 billion loss into a profit just by changing their mind about how math works. I know what you were thinking. Why is this so rigid? It's my company. Why cannot I just decide to calculate depreciation differently this year if I feel like it? Why do I have to go back and rewrite history just because I changed a rule? It feels like the IASB, those tea-sipping, joy-killing bureaucrats in London, sits around trying to invent ways to make our Excel sheets crash. IAS 8 demands you treat the financial statements like a crime scene you have to scrub clean. It's annoying, it's time-consuming, and quite frankly, if I wanted to spend this much time dwelling on the past, I would go to therapy. To understand IAS 8, you have to understand the difference between a lifestyle change and a bad guess. Imagine you are dating a girl named Corporate Jane. 1. Change in accounting policy, the lifestyle overhaul. One day, Jane wakes up and decides she is now a hardcore vegan. This is a fundamental shift in her operating principles. If Jane were following IAS 8, she would not just start eating tofu today. Oh no, she would have to go back into your shared photo albums, Photoshop every burger she ever ate out of the picture, and replace it with a kale salad. She has to act as if she has always been a vegan. She has to restate the past so that her current vegan self is consistent with her history. If she does not, looking at pictures of her eating ribs last year makes her look like a liar today. 2. Change in accounting estimate, the bad guess. Now imagine Jane buys a giant bag of spinach. She estimates it will last her 1 week. 3 days later, it's a slimy green puddle in the fridge. She was wrong. Does she go back in time and pretend she never bought it? No, she just throws it out now and buys a smaller bag next time. She fixes it moving forward. She does not need to rewrite history. She just admits she is bad at guessing vegetable lifespans. 3. Prior period error, the outright lie. This is where Jane realizes she forgot to tell you she was married for 3 years in the 90s. That is not a policy change. That is an omission. She has to fix the record immediately and apologize for the past deception. Now let's translate Jane's neurotic behavior into the boardroom. Accounting policies, the vegan principle. An accounting policy is the rule you use to prepare accounts. You can only change it if the law requires it or if it results in more reliable and relevant information. You cannot change it just to smooth out your profits. If you change a policy, you must apply it retrospectively, as if you had always used this new policy. Why? Comparability. Investors need to compare 2024 to 2023. Accounting estimates, the spinach guess. Accounting is full of guesses. New information comes in, and we realized we were wrong. Changes in estimates are applied prospectively. You do not touch the past numbers, you just adjust the current year and future years. Why? Because you were not wrong back then, you just didn't have a crystal ball. Errors, the secret marriage. If you find a mistake at your birthday or a misapplication of the standards in a previous year, that is a prior period error. You must correct the opening balances of equity for the earliest prior period presented. Here's the bottom line, and write this down because it will save your career. Auditors love to fight about whether something is a policy or an estimate. Why? Because changing an estimate is easy. You just tweak this year's profit and loss. But changing a policy is a nightmare of paperwork where you have to reopen last year's books. If you want to keep your job, aim for consistency. Investors smell fear when a CFO starts changing accounting policies too often. Pick a policy, stick to it, and only change it if the standard setters put a gun to your head.